That scapegoat someone, that one person. Absolutely terrible. Just awful.
Okay. Good morning, everyone. My name is Cincy Mary, and this is my group members.
I'm Eddie Tapia.
So we will be presenting on foreign ownership of U.S. Treasury securities. So in this presentation, you can expect a summary of the case study, and then we will go into the analysis and findings, and then we will conclude. So before going into the summary of the case study, I'll be going through some of the key terms that are used throughout the case study. So Treasury securities. What are Treasury securities? These are debt instruments issued by the U.S. Department of Treasury to finance government spending. These are considered one of the safest investments as they are backed by the U.S. government. And U.S. government actually do maintain a record of these marketable Treasury securities in national book entry systems. So there are different types of Treasury securities. And they are issued on the basis of their maturity. So the one security that has the least maturity is Treasury bills. They are issued for 4 weeks to 1 year of maturity, and sold at a discounted price and is paid at the face value during the maturity. And Treasury notes have a maturity of 2 to 10 years, and Treasury bonds have a maturity of 20 to 30 years. Both these securities are paid interest semi-annually and are returned the principal at maturity. Treasury inflation protected securities. These are also known as TIPS. The principal adjusts with changes in the consumer price index. It is adjusted to the inflation rate. If it goes up, the principal will go up, and it adjusts accordingly. So the interest rate and the principal amount will adjust according to the price index. It is issued for different maturity periods, 5, 10, and 20 years. So it started when Alexander Hamilton, he was the first Secretary of the U.S. Treasuries. So he wanted the U.S. to honor the obligations not only of the Continental Congress, but also of all the individual states that funded the War of Independence. So he persuaded the government to honor all the obligations despite how it incurred or who held it. So following Hamilton's approach, U.S. has never defaulted in any of its debt payments. So it is a tool for financial stability and growth, and it has grown from 75 million to 7.9 trillion in 2005. But this is mostly marketable Treasury securities, and this aligns with globalization trends and wealth accumulation in foreign markets. So how is it sold? So these securities are issued by the U.S. Treasury and are sold through single price Dutch auction. And the auction is announced several days in advance, and it is usually only a number of people involved in that auction, known as primary dealers, but they are selected by the Federal Reserve Bank of New York. So they act as counterparts to trade the securities in the secondary market. Everyone is welcome to bid, but it is mostly done by these main participants, which are big financial institutions. So they can it's a big amount, and only those financial institutions can actually competitively bid for it. So competitive and non-competitive bids are submitted, and non-competitive bids are subtracted from the total bid amount, and the competitive prices are filled accordingly, and all the winning bids are awarded the highest yield accepted. It doesn't matter if it's only a little bit amount of the highest yield, but it will be given for every winning bid. And the secondary market, the primary dealers facilitate trade in the secondary market. If the primary dealers want to trade in between them, there comes the inter-dealer brokers. They provide an anonymous platform for the primary dealers to trade between them, and they will not be knowing whom they are trading with. So the key observations in this case study are as I said, Hamilton's approach. It made sure that U.S. not only fulfill its moral obligation, but also by paying its debt, it reduced borrowing caused by the building investor trust in U.S.'s ability to pay its debt. So most of the like this, like 20% to 50% by 2004, most of this is marketable treasury securities. It is it shows the government's reliance on foreign capital to fund its activities like fund programs, war, infrastructure, and other activities. But like it allows lower borrowing costs because these treasury securities are fully backed by the faith and credit of U.S. government, so they are virtually risk-free. So everyone wants to invest in these treasury securities. So the increase in foreign ownership of U.S. security mainly aligns with globalization trends and rising wealth in rising markets. Countries with a huge trade surplus invest heavily in U.S. Treasury securities to manage their foreign exchange policies and like to manage their currency stability. So foreign central banks and other wealth fund sovereign systems actually prefer U.S. Treasury securities because they provide liquidity and stability, and also they are safe because the U.S. government is known to pay its debt back. But despite all its benefits, it has certain vulnerabilities because U.S. depends a lot on foreign capital, and if there is a sudden shift in foreign exchange policies or like a reduction in the treasury security demand, it will completely disrupt the treasury market and increase borrowing costs for the U.S. Also, there's a lack of transparency in the foreign participation at auctions. So it's like you don't know how much a foreign country is actually buying your treasury securities. So it can potentially affect the market pricing and the auction outcomes. So these are the main points in this case. So I'll be passing it to Eddie, who will go through the questions.
All right, thank you, Tinsy, for that awesome detailed explanation and a little recap of our case. Now we're going to get into the analysis and the findings. First off, I want to ask a question here. Why would anybody really want to invest in U.S. Treasury securities? Tinsy touched on it a little bit earlier, but it basically gets broken down into three parts: safety, stability, and liquidity. When people are interested in U.S. Treasury securities, they're interested in a low-risk investment, right? They're not going for options, they're not going for crypto or something like that. So safety is usually at the forefront of their mind. Most of these Treasury securities have fixed interest rates, as she explained, so people can clearly see out on paper how much they're getting paid, how often they're getting paid, what the principal is going to be, and so on. Also, she touched on a little bit is Treasury inflation-protected securities. These are basically securities that are hedging against inflation to make people feel a little bit more safe. The next is stability. The U.S. government has never defaulted on a payment. So you know if you give the U.S. government $5 million in bonds or $5,000 in bonds, you got about a 99.999% certainty that you're going to get paid back. The next reason, liquidity. These are relatively liquid. Now, you can't easily access the money and pull it out like you can some other investments, but what you can do is you could buy them and sell them quickly, and billions of dollars worth of transactions every day are happening around the world. Because of all these transactions, that's increased a lot of domestic demand as well as global demand. So basically you could see the top 3 points: safety, stability, liquidity. Remember those 3 points because they're going to be a little bit of a topic as we go forward. Let's get to question 1. Which countries or regions are on the list of top holders of U.S. Treasury securities? Do you find anything surprising? Well, for those of you following along, we get this answer from Exhibit 3 towards the back end of the case. This is from the Department of Treasury as of December in 2004. Japan was holding $712 billion, China $194 billion, and the United Kingdom at $164 billion. Now this seems to check out with our research, as Japan and China are 2 of our largest trade partners, and the United Kingdom is one of our largest allies. To talk about this, I want to bring up the trade balance and how we conduct trade with these other countries because it involves how we invest with securities. Let's start with the US. The United States is the largest importer in the world, guys. We import more than anybody else. Because of that, we tend to operate on a trade deficit. What that means, if you guys aren't following along, if we go and we import $500 billion worth of goods from China, but we only export 100 million, that means we're at a deficit of 400 billion, right? So because of that, countries like China, and you can't see it here, but it should say Japan under this, countries like China and Japan tend to operate on a surplus, which means they have excess currency. When they have this excess currency, they need to find something to do with it. They're not just gonna let it sit in the bank and just accrue 10 or 5 or 0.5% of interest, right? They wanna go and diversify their portfolios. So they invest in our national debt as a hedge against inflation and another currency. One of the things they also engage in is currency manipulation and stabilization. So as we kind of talked previously a little bit, China likes to manipulate the yuan. At the time of this, they were trying to make it more competitive, so they were controlling the appreciation. They didn't want it to get too high, because if the currency gets too high, it doesn't look advantageous for buyers who want to buy their exports. Japan also does similar, but the Japanese banks were actually implementing this. They wanted to weaken the yen to help boost their exports as well. Now, when you're weakening a currency, you obviously need to back it by something else. So this is why they buy U.S. Treasury securities, to help them be more secure, backed by the U.S. dollar, backed by the U.S. government. I want to touch real quick on the United Kingdom because it's a little bit of a different trade partnership we have. Anywhere from year to year, we could be in a trade surplus with the United Kingdom or a trade deficit. So all these things that I just mentioned will apply from year to year, but they fluctuate. One of the things that we do have to bring up when we talk about the United Kingdom is their capital city of London. They're a global powerhouse of investment, especially in Europe. At the time of this report, December 2004, they were still involved in the European Union, which means a lot of countries in the EU, Spain, France, all those countries, a lot of their investors will invest through the United Kingdom, hence why we might see an uptick on this national report. Let's get what we found surprising. Quick. We found 2 things surprising on here. First was Caribbean banking centers, next was OPEC. So we've all heard the terms in social media and pop culture, oh, they got offshore bank accounts in the Cayman Island, but this sentiment does hold true. These Caribbean banks have been gaining a lot of currency recently due to foreign direct investment, as well as tourism and domestic production in these own countries. They started to grow over the years. Hence why these banks have so much money, they need to diversify. What better thing to diversify than U.S. Treasury securities as a safe, stable, low-risk investment? Similarly, OPEC also follows this strategy. For those of you not familiar, OPEC stands for Organization of Petroleum Exporting Countries. So these are countries like Saudi Arabia, Oman, UAE, and Venezuela at a time. These countries are pulling billions of dollars of oil out of the ground every year, so they have a lot of excess cash. And again, you don't want that cash just sitting there. If your money's just sitting, it's not making money, you gotta put it out there to work and diversify. Now we're gonna get to question number 2. Why is foreign ownership of U.S. Treasury security rising, and what are the underlying contributing factors? I don't wanna really beat a dead horse here. We know this first, why foreign ownership is rising kind of from what I'm talking about. It's a safe, stable, liquid investment that a lot of people want to take advantage of. Also, foreign governments can use it to manipulate and help subsidize their own currency and a lot of political aspects. I really want to focus here on the underlying contributing factors. The 3 main ones, domestically, there's low saving rates in the US. If you put your money in a bank, you're probably only making 0.5%, 1% if you're lucky. Now there's some high yield savings accounts, but they don't really do much either. So a lot of people tend to always go and trade U.S. Treasury securities because they're more advantageous than the normal rates. The next is our government runs on a persistent budget deficit. So this is similar to our trade deficit, but this is our internal budget. How much do we spend on healthcare? How much do we spend on the military? How much do we spend on roads? Things like that. We're always at a budget deficit just because that's how it's been for so long. What causes that? High government spending. Now, we've always heard in the mid-2000s to even the teens, a lot of politicians say, we gotta balance the budget, we gotta balance the budget. And it's very hard for them to balance the budget when they spend so much money. Because of this spending, they get into this vicious cycle of money in, money out. If there's no cash flowing through the economy, there's no cash flowing out of the economy. Now, I have a good personal story that goes along with this. When my father first moved here from Mexico, he was able to get a job working with Broward County in the Chamber of Commerce. One of his first assignments was to throw an event. So he had to organize the tables, the lights, the chairs, so on and so forth. So he went to every single vendor and he negotiated the best possible rate he could from every individual person. They went and they had a wonderful event and they saved a ton of money. After the event, he went to go talk with his boss and his boss told him, Edgar, I really wish you would have spent more money. And he said, why? Why would you want me to spend more money? And he goes, well, This is how the government works. If our budget's $10 million this year, but we only show that we spent $8 million, next year, they're probably gonna reduce our price to $8 million. But if we have a $10 million budget and we spend it all, next year they're probably gonna bump us up to 12. So this kind of thinking is ingrained in the government all the way at low levels like Broward County, all the way up to the federal level. This constant money in, money out, keep the machine rolling mentality has really started to damage it. Hence why the U.S. Treasury, or excuse me, the U.S. government is really trying to get a lot of not only domestic but foreign buyers of these Treasury securities to keep that cash flowing through our economy. Now, I covered question 1 and 2 pretty well. I'm gonna release my time to pass it over to Alea, and she's gonna cover question 3.
Thank you so much, Eddie, for this great contribution to the topic. As we now understood that U.S. Treasuries are a safe investment for a lot of foreign investors, and we understood who the investors are most likely, like Japan and China, it is really important to talk about the foreign ownership and how their changes in their systematic play can affect the U.S. economy. We have seen that the foreign ownership of the U.S. Treasury significantly increased in the past. That means that foreigners have the power to influence the U.S. economy really heavily. They can influence the interest rates, the borrowing costs, and the economic stability within the U.S. So it is very important as the U.S. to analyze the situation and always have a response planned to their next step. It's like playing chess. If China does something, I need to have a response for that, and I need to be prepared so my economic stability stays maintained. So in the case, we had 3 situations. The first situation was, what if, let's say, foreign banks start to accumulate more U.S. Treasuries because of, let's say, a financial crisis, and afterwards they want to buy way more U.S. Treasuries. What kind of effect does that have on the U.S. economy? If foreign banks buy more U.S. Treasuries, the demand for U.S. Treasuries increases. If the demand for the U.S. Treasuries increases, the bond prices increase, and the yields are lower. If the yields are lower, the interest rates declines within the U.S. due to the increased demand for the treasuries. If the interest rates decrease, the real value of the U.S. dollar rises. All of those things have consequences for the U.S. itself, and that just because a foreign investor made a move. There's some good consequences and some bad consequences. The good consequences would be that me as a U.S. citizen and as a U.S. business, I have lower borrowing costs because my interest rate is pretty low and I can spend a lot of money and consume more. But the problem is the appreciation of the dollar makes the dollar more expensive, and therefore it is way harder for me to export. And that creates the trade deficit that the U.S. mainly has sometimes. And because a lot of foreign investors bought a lot of U.S. Treasuries, the dependency of the U.S. on the foreign investors increases. So I am more vulnerable. If somebody owns more of me, I am more vulnerable and they have more power to hurt me. So that is also a negative play of what they can do to me. So it is not always good to be dependent and always borrow more and borrow more and borrow more. I have to be stable myself as well. Then we have a second case. As you can see in the case, if you have read it, it was, what if me as the US, I have a budget deficit and I need people, and I need to borrow and I need to start selling US Treasuries. So it may sound same like case A, more US Treasuries are being sold, but the difference to case A was the driving force were foreign investors. Foreign investors wanted more US Treasuries. Now in case B, the driving force is the US itself. I want to sell more US Treasuries. So what does that make of an impact in the US? There's a short-term and there's a long-term effect. So the short-term effect that says that the strong foreign demand stabilizes the interest rates because I had a deficit, I sold more US Treasuries, I got more money into the country, and I stabilized the interest rate. But long-term, the large debt supply may require higher interest rates to attract buyers. If the interest rates are always low, why would I, as China, go and buy more and more and more US Treasuries if I could go to Japan and buy their Treasuries and get a higher interest rate? Of course, interest rate is not the only reason to buy a US Treasury. As we heard from my other peers, it is also about stability and it is also about creating reserves in a different currency, but interest rate is also a good take. So long term, the US has to maintain somewhat of a good interest rate to make those treasuries, like, how do you say, to make them attractive. Yes. So what kind of risks and benefits does that make? Because of the high interest rates, borrowing costs for the US government increase. Last case we had, in case A, we had decreased. Here we have increased. It is harder for me as the US government to borrow. And because of the potential dollar depreciation on the long run, the foreign confidence in the US weakens. It means that if the foreign investors always see the US wants to borrow more, and sees that the interest rates are fluctuating and the US seems unstable, that creates a lack of trust from foreign investors to the US. But the benefits, for example, are short-term. This is a good tool to stabilize the interest rates within the US. And the strong dollar makes imports cheaper for US consumers. So that's a nice thing as well. Then in case C, we had the demographics and the question on how demographics can influence US Treasuries and the economic stability of a country. So what we learned from the case is that aging populations in developed economies tend to lead to higher savings and lower labor force participation. I mean, it makes sense. Old people have a lot of money and they retire, they want everything to be safe and they don't want to work anymore. And it's the opposite with younger population in emerging economies. We young people, we're still hungry for money, we still want to make that money, we want to invest it, and we want to grow and grow and grow. What does that mean for capital flows and US Treasuries? Because an aging population want to save, they tend to buy more US Treasuries because it's a safe and stable investment, as we learned from my peers. And younger population rather buy the US Treasuries not to save, but rather to create a good trade economy within the US and build reserves in the US so they can evolve and create a developing economy in their own country. So now the overall conclusion of this presentation. We hope you enjoyed and you got to take away that US Treasuries are a safe haven asset. A lot of governments, foreign banks, and institutions like to buy US Treasuries because they are preferred as a low-risk investment and they create a global economic development. The ownership helps regulate the US interest rate. That is what we learned from the cases A, B, and C. And US Treasuries have a high economic influence. Changes in treasury demand and supply have a real impact on exchange rates and capital flows. And every move from foreign investors has to be responded to with a different move. And there are potential risks for because of US Treasuries and mainly for the US itself, because a heavy reliance on foreign investors can lead to instability in confidence weakens. And all in all, we would say that U.S. Treasuries are a very good government borrowing tool. They are very good to stabilize things, to change the fluctuation of money inside the global market, and to create exchange rates the way you want them to be. And it is just a very good tool that everybody uses nowadays. Thank you so much for listening and for watching. And if you have any questions or feedback, we are open.
Okay, I'm gonna ask at least one of you to come back up, but sit down for now. Who wants to give positive feedback, come up? 1, 2, 3, okay. And who wants to do for next times? 1, 2, 3, okay. So my positives, please say your name first before you go up.
Yes, sir. I won't go through too much of a list. Give the other positive speakers something to say. I'm Andrew Jahara. So opening up, I guess, and it kind of will feed into what else I say. We'll spare some for them. I thought the presentation itself was put together very well. I thought the bullet points were to the point, not dense. And I thought that you guys were able to speak to it very well without, some overly relying on, turning back the reading. The pages never felt like too much. I think you stuck to the main points very good. And what am I saying here? Led into it good with a good introduction, a nice recap, which I think was good because I'm right. I don't think too many people in here have had a lot of finance. So I think that was super helpful. I thought the presentation was good, streamlined, to the point. I won't keep talking, so you'll have something to say.
We appreciate it. Thank you very much.
Alright, I'm Emmanuel Asifo.
What's your name?
Emmanuel
Emmanuel.
Asifo.
Okay.
Yeah, so basically it's not going to be different from what Andrew said. I really like what you did, like the second presenter, what's your name again?
Eddie.
Eddie,
Thank you very much.
he was able to explain, communicate to us, and he explained the points emphatically, and I like the way you concluded. That's the main points, like U.S. Treasury is a safe haven, so if you want to invest, you may have to consider the U.S. Treasury as compared to other, maybe the sovereign bonds and other things which will come up next week and other weeks. So that's what I want to say, like you spoke to the issue, and you gave an advice to investors, like what we should consider, so that's what I would say, yeah. Thank you.
Thank you very much. Appreciate the feedback.
Thank you.
Well, I'm Luis Rosas, and the presentation itself, I like the flow of it, like the introductions. You guys were like, great job by this person, this and that. Like the introductions when you guys broke up was great, and also like you guys speak equally. Nobody really. It's hard to tell like who did more because you guys seemed like everybody was equal. Also, the visuals in the presentation, they weren't like too distracting, but they were pretty professional. I like that. And also the content of the presentation itself was great. Everything was explained in detail, and very important facts were reiterated again, which just proved the point stronger. So I like that. Like it was proven that the bills are one of the safest investments, and that the U.S. hasn't defaulted in any debts. And that was reinstated and proved the point.
Thank you very much. Really appreciate the feedback.
Next times.
Like,
I had 3 volunteers.
Yeah, the three. Let's
Yeah,
say
what happened to you
what we
guys?
could do better next time. Constructive criticism. The 3 people that say for next
The
time.
3 people said who
Oh,
did
they're
for
being
next
streamed.
time.
I thought that maybe they rose their hand.
Oh, listen, people.
Positive feedback.
No, I said for next time. For next time means negative feedback. So who wants to give negative
I'll
for
go.
next time? 1, 2. Who else?
Just
One
go
more.
up there and drag us through the mud. It's okay. We're not gonna. hold you
Everyone's
guys
gonna
to-
get it. 3.
Constructive criticism is good, guys.
I'm not gonna grade you on the criticism. I'm gonna grade you on whether you did it or not.
Well, thanks for sharing.
How's it going, everyone? My name is Chris. Constructive criticism, I would say, Aaliyah, just next time, you said a lot, like, just prepare it a little better. And Eddie, I would shave your beard next time. Looks more professional like
Yeah,
that.
that's fair.
If you wanna do that, but,
Throwing stones from glass houses, though, huh?
what's that?
Throwing stones from glass houses.
Yeah, man, I'm just saying, you know, I might shave my beard with my presentation, so that's it. But, other than that, that's all I got.
Okay.
Thanks, Greg. Appreciate it, buddy. You don't come clean shaven?
I'm
gonna
had to
be
shave
shaved.
now, man.
Oh, good.
This is not interactive, ladies and gentlemen.
Hi everyone, my name is Svana, and it's a great presentation. If I
You
I
can't
have-
say
Oh,
that if
sorry.
you're doing for next
Okay.
time. You can only give the for next
Active
time feedback.
Okay. For one feedback is you can add more like visual data, like chart. I see a lot of chart in the case study. There's a lot of exhibits, so it will be more effective if you add this. It's
And what's your last
feedback.
name?
Svana Sulaiman. It's supposed to be Sulaiman Svana.
Okay, okay, so.
You can't find me?
You're not Shujang, no?
You gotta write her onto the list.
Sue, are you Sue?
Svana.
Oh, you're down at the bottom.
Yes.
That's what it is, I didn't write you. Okay, Savannah, yes ma'am.
Thank you for the feedback.
Savannah, okay, who else? What's your name?
Kazaya, so
So, okay.
yeah. I think something you guys could work on is, she kind of mentioned it, the graphics, maybe some charts, but also maybe like an audience connection where you guys ask the audience a question so we're more involved. And I would say probably walking around more. You did it, but maybe like the other two. That's it.
Okay, thank you. Okay, I thought you were all good presenters. It was clear. I liked your slides a lot, and I thought you covered the questions very thoroughly. Okay, Tinsy, explain to me about the competitive and non-competitive bids, because I did not. You got faster, which made me think you weren't real comfortable with that.
Oh, it takes some time to explain it. That's why, I thought like. if
Okay,
you-
explain to me now.
Okay.
Take as much time as you want.
Okay, so. Okay, so two types of bids are they allow two types of bids, competitive and non-competitive bids. So what they do is they non-competitive bids are only for like a short quota for that. So after they close the auction for both of this, non-competitive bids are closed at 12 at noon, and competitive bids are closed at 1 p.m. So after that, they will minus the non-competitive bids from the total issuance of the Treasury securities, and the rest, the competitive bids, are filled up according in the ascending order of the yield rates. Like if there is if US have need for $5,000 million, and non-competitive bids have filled up to 2,250, and the rest of the competitive bids are for if $2,000 was for 1.2 percentage of interest rate, and then $1,000 in 1.3 percentage. But there is it's just $3,000. No, it's more than that. How should I explain that? Is there a pen? Because I cannot explain it via saying.
A what? Is there a?
With what I can can I show it on the
Sure,
board?
you can show it on the board. Let me turn off the projector. Or you can do it in the center.